Hello, Deep Valley community. Welcome back. Thank you for your support and thank you for sending me questions that I can try to address. Um, as Buffett says, the best way to learn is really by becoming a teacher, and he says that that's what he set out to do through Berkshire. And obviously, Monish says the same, and Charlie says that this kind of is a bit like a church, that the more you kind of shout it out, the more you pound it in. So I'm going to talk through some examples of some financial tricks, and these companies that I'm going to highlight to you are all companies that I was invested in at one point or another, and I've made mistakes, and hopefully you'll be able to see these mistakes and learn from them. Okay, so the first company I'm going to highlight to you is FOSL. This is the cash flow statement. And you can see for the 2016, 17, and 18, it's cash flows from operations. I have just selected this bit just to ignore the rest of the stuff as just noise. So you can see here, the cash flow from operation looks very stable. And when I saw that the company was being priced at 600 million market cap, I think to myself, hey, this is a business that is trading at approximately 3 to 4 times free cash flow. That's a bargain opportunity. And the lesson that I learned in hindsight, and actually it was one of the few occasions that I actually was quite lucky, and I deserved to come off a lot worse, was that you can see that it's basically the accounts receivable that is getting liquidated. So if you compare here, so here the accounts receivable is negative 12 million, 13 million. Here it's positive. So there's a huge difference between being negative 13 million cash burn to liquidating and being positive. And on the next year, they liquidated even further the accounts receivable. And here, the difference between this year and 2017, you can see that, and this year, it's approximately 145 million, that they basically, the inventory just kind of jumped up here. So at the time, I didn't give enough consideration to that. I was like, okay, they're being really wise with with the way that they're squeezing the working capital. But I should have given this more consideration at the time, and everything is in hindsight. So if I'm showing you this video, hopefully you'll learn. So I'm going to fast forward a little bit in time, and you're going to see that after 2019, something happens. That accounts receivable, especially the inventory, reverses. Can you see there? 153 million was a cash infusion in 2018, and then it reverses in 2019. This is 10K I'm looking at. So you can see that the cash flow from operations turns negative. Now, without any narrative about the story, whether, watches or getting destroyed by wearables or anything like that, just by focusing on this part here of the net working capital changes, just by spending a couple of minutes here, you can see straight up that this business is not as strong as I was being led to believe. Let's go back here again. So you can see here that I was under the illusion that the cash flow from operations was strong, but indeed it was not. So that's one lesson that I learned with FOSL. So the other company I'm going to talk about is GNC. So this one here, so this is for the years 2019. So this is just finished. I also used to have a position in this company. This was a position that I did lose significant amounts of money, and I've talked about that before in another video. So here you can see that the way it works is that they have diluted out the shareholder, and they have sold some shares, but they've got cash in exchange. So this cash is added back to the business because they've taken a loss here on the net income statement and net income, but it's added back. Can you see? So this loss on asset exchange, so is on a venture, that loss is added back as it's a non-cash charge because it's going to happen in the future. But even while getting caught up in all these details, it doesn't make sense, right? The business of GNC as a retailer is not in the business of making an asset exchange. So even if you don't know anything about this kind of thing, you can just understand, okay, this is abnormal. This is a non-recurring event. So if you look here, the net cash from operations looks strong at 97 million. Now, you would just think to yourself, okay, this here is a non-recurring event, so um, I'm gonna subtract that out. So if you subtract from 96 to 21, you're left with approximately 75, let's say thereabouts. So it's already not as strong. And here the same thing when they did the convertible in the same year, so that gets added back as well. So if you just look at those two, just approximately 37 million that you kind of taken away from here, the net cash from operations, rather than being 96 million, is approximately 60 million. So just from those non-recurring events. So these two examples that I've picked for you, this is something that happened in the past, and I'm just kind of highlighting from my experience from the School of Hard Knocks what I've learned, okay? But trust me, I am getting a little bit wiser now, and I'm going to give you another example. So this is Bed Bath & Beyond. I don't have a position in this anymore. Now, if you want, you can pause the video to see if you can figure out what's happening here. So if you want, this is a good time to pause if you want to do an exam for yourself. So here, on this example, you can see that the net cash from operating activities is looks strong. You know, this market cap of the company is approximately in the ballpark of 600 million today. This only reported last night, and shareholders have just gone crazy about this. But if you look here, it's the bulk of it is really just the merchandise that has been liquidated. Can you see that? Like it's close to like off the top of my head about 88% or something of the cash that they've made is actually just the inventory. So that's like you can't keep liquidating. You know, you can't keep liquidating your inventory because you have nothing to sell. Similarly here, sale and lease back transaction. So you can think here, okay, they're sold. This is a bit of a complicated thing. Maybe I'll go into it in a different video. But a sale and lease back, it just means that they had some real estate, they have sold it, but now they're leasing it back. So as they sold that real estate to a different company, they no longer own the real estate. They've made a profit from selling that. So they've made a one-off cash infusion, but now they have to pay the rent. So in the long term, it's not as beneficial. Otherwise, the other company wouldn't get involved. So no one's a charity. But in the short term, if you're desperate for some cash, you can sell off an asset, you can lease it back, and your shareholders on your short-term shareholders are going to see, wow, this is really strong. So you can see, without kind of getting dug around too much in details, just see sale leaseback. That's something that's kind of like not going to happen next year, and or if it does, it's something that this come off the balance sheet. So these are a couple of things that I've kind of I think are useful to know. And hopefully, if you you adopt this, you'll also be able to not go through this mistake. So as always, please keep sending me your questions, and I'll keep trying to address them. And please do subscribe, so that because this is our value investing journey. Thank you for watching. Bye bye.